I want to go straight in on a fairly punchy report that you guys are putting out recently, really about proxy advisory firms and how they affect the voting process and how that's, in a way, disservices retail investors. So you are calling for a stop to what you refer to as the nonsense from the likes of Glass Lewis and ISS, saying they give a major advantage to Wall Street investors and hide conflicts of interest. Tell us what you really think. So what should they be doing differently? What could they do that would actually make it more equitable for retail investors?
Well, first of all, I think it's important for people to know how important of a role the proxy advisory firms play. I mean, there are some studies that suggest that ISS, for example, can sway a vote 25% either way. So this is actually a really big deal. And I think that, you know, from our perspective, the Main Street Investor Coalition, we want to make sure that there's more transparency amongst the proxy advisory firms, right? There are apparent conflicts of interest in some cases where they're offering consultant services while at the same time they're providing recommendations, et cetera, for their very clients. So we want to make sure that the recommendations that they put forward, again, are as transparent as possible.
And how does that apply to retail investors? Because the proxy advisory firms, typically their relationships with the big institutional investors, and
right.
They don't really, there's no filtering down to retail investors.
Right, well, a good question. Look, the vast majority of retail investors have no idea what the role of these proxy advisory firms are. They have no idea that they have so much sway and influence in the whole sort of corporate governance space. And this is, you know, this isn't a totally new development, but it's really been over the past few years where it's really taken in large effect. But
do they care, retail? I mean, they're making money. You look at the S&P 500, I think it's up, you know, somewhere in the region of 70% over the last 5 years. So whatever decisions are being taken, whether or not they benefit the institutional investors or the retail investors, they see everyone seems to be winning. So what's the concern? Well,
I think they care. I mean, I care. I know that you care, you know, what's going on with your retirement. But look, again, the vast majority of retail investors don't know what's going on, and they certainly don't know the level of activism that proxy advisory firms are moving into, particularly when it comes to disclosure. And, you know, and the crazy thing is, you know, these guys are incredibly opaque, and I've argued, me being former CIA, that they're actually more opaque than my former employee or employer, so to say.
Now, another area where you guys are spending a lot of time at the moment is around ESG and what companies could be doing better, but also potentially, and this is a very controversial view, I suppose, how ESG is potentially a net negative for investors. It distracts companies, it prevents them from doing things that would be right. Sort of better for profits. So just talk that out a bit. What's the issue with ESG? Because it seems like the push at the moment is definitely towards companies doing more of it.
And by the way, you know, I want to make it really clear that we're not against ESG per se. We just want to make sure that ESG, really two things here. First of all, that retail investors have more transparency and know what's going on with ESG. And then second of all, what ESG proposal is put forward actually provides value to the stock and helps the average retail investor.
And is this feeling that the proposals that are put forward on the whole do not do that?
I think it's questionable. I think it's questionable. If you get into the actual substance of a number of these proposals, it's highly questionable. And there was a study that was released by the National Association for Manufacturers a few weeks ago that basically looked at this with a very sophisticated econometric analysis and study, and they came to the conclusion that despite some of the arguments that this type of disclosure provides almost automatic value to the stock, it's very questionable, right? It's statistically insignificant one way or the other.
But the argument surely is that the companies are being expected at the moment to pick up where the politicians are leaving off. There's so much inertia around, particularly around environment policy at the moment. Wouldn't investors be more concerned if they felt companies were putting profit before, you know, not just at the top of the agenda, but ignoring everything else and just focusing on profit? So
I'm with you, by the way, and that's a really good question. Look, we need a national consensus on a lot of these issues. But, you know, when it comes to the environment, the U.S. Environmental Protection Agency is second to none when it comes to enforcement and compliance across the board. And I would venture to say that our companies are the cleanest in the world. No matter, we can stack them up against anyone.
But is that because they have historically been regulated to do so, or is that because they've taken that choice themselves under pressure from investors?
Right. Well, no, they're responding to regulation. They're responding to environmental regulation across the board. And this is one of the weaknesses of some of these proposals, is that the proposal oftentimes will suggest a future regulatory framework which doesn't exist.
But we're in a period of really drastic deregulation. So if the companies don't regulate themselves, or if their investors don't expect them to behave better, then where does it end?
That's a good question. I think there's a lot of mythology around this deregulation piece. I mean, certainly the Trump administration has worked really hard to roll back some of the onerous, burdensome regulations that the previous administration put forward. But again, our environmental enforcement and compliance is second to none.
Another area where I suppose we're hearing a lot is from the likes of BlackRock or Vanguard are becoming much more vocal about what they expect from companies. Do you think there is a disconnect between the interests of some of the biggest money managers and the smaller retail investors that your group represents?
I do. I mean, look, again, and this goes back to some of your earlier questioning. Look, if the average retail investor knew that BlackRock and Vanguard were using management of their assets to pursue some type of political, social agenda that they didn't agree with, they'd really, really care about it, especially if that political, social agenda actually hurt the value of the stock over the long run.
How do they, I suppose, how do they manage that difference in desires from the investments that they have? Because the retail investors typically have less time and less means to actually exercise their voting power efficiently. So how does a body like yours actually enable retail investors to have more of a voice and to be able to do more when it comes to voting their shares?
So we're very new. It's a work in progress. Look, it's important for us to really get creative when it comes to ideas and possible compromise here, because we also want to engage the BlackRocks, the Vanguards, and the proxy advisory firms, because it's important for us to work together to figure out, how should we move forward? Is there a way to provide a greater voice to retail investors? And there's some ideas. Proportional voting, for example, has been thrown around, and it's something that we certainly want to consider.
So work in progress rather than a silver bullet for now.
Precisely.